What are exchange-traded funds? In this video, we go through all the things you need to know to get started investing in exchange-traded funds, like the most common types and why you should invest in them. But first, remember to like and subscribe to our channel for more content like this, and don't forget to click on the notifications button to get updates. Getting started. Looking to diversify your investments, spread your risk, or gain exposure to a particular industry or market? With the ability to trade just like stocks, ETFs have become an increasingly important investment tool. Just like other types of funds, they pool together money from investors to invest into a basket of different investments, including stocks and bonds. Some of the most popular ETFs aim to track the performance of a specific index or sector, such as the S&P 500 or the technology sector. They can also track a commodity like oil or gold. ETFs emerged out of the index investing phenomena in the late 1980s and early 1990s. Although they were made famous as index trackers, they were not the first to take this approach. The passive investing revolution, which is also known as index investing, is a simple strategy that involves replicating the return of an index, began in 1975, with Vanguard launching the first index mutual fund. Investors, however, were still lacking the major benefits of ETFs. In other words, the possibility to trade fund shares on an exchange. This next step came about in the 1980s with the development of electronic trading. Eventually, traders started to look for ways to purchase all the components of an index in a single trade. A solution came in 1993 with the launch of the first ETF in the US, the SPDR S&P 500. The SPY was an immediate success and grew to become the largest ETF in the world, with assets under management reaching $364 billion as of April 2021. What's so appealing about ETFs is that they cover a broad range of asset classes and can give you exposure to specific markets, industries, or investment strategies without having to concentrate your risk in one single investment. Investors could earn a return in two ways: a rise in the ETF's market price and dividends. Typically, if the value of the ETF's investment increases, so does its price. So if you had purchased an ETF at $40 and a year later it was selling for $50, you could profit $10 per share by selling your position. An investor could also gain income if the ETF pays a dividend. In other words, regular payments of profit made to investors. What are the different types of ETFs? Whether you're looking to generate income or partly offset risk, there are many ETFs that can help you achieve your financial goals, even with its own objectives. Here are some of the most popular types. Market ETFs track a particular index, such as the S&P 500 of NASDAQ. The SPDR S&P 500 is one of the most widely known ETFs that tracks this index. Bond ETFs offer exposure to various types of bonds, be it government bonds, international bonds, corporate bonds, high-yield bonds, or treasury bills. Sector ETFs track a particular industry such as healthcare, technology, and energy. At times, they may even track a subsector within these industries, ideal for those looking to invest in an entire industry. An example of a sector ETF is the DRIV ETF, which invests in companies that develop autonomous vehicle technology, electric cars, and EV components and materials. Commodities ETFs invest in commodities like oil, gold, natural gas, and others. Currency ETFs invest in foreign currencies like the euro or the Canadian dollar. Some large currency ETFs include Invesco Currency Shares Euro Trust ETF and the Invesco Currency Shares Australian Dollar Trust. Why invest in ETFs? Since ETFs are traded on stock exchange, you can easily place an order to buy and sell them at any time, provided the market is open. And since ETFs are traded just like stocks, investors can place a variety of order types, like limit orders or stop-loss orders. Participating in the wide market with only a single purchase instead of multiple purchases via different stocks can save an investor time from researching or conducting technical analysis. In addition, ETFs give you access to several investment options that cover a broad range of asset classes, sectors, and geographies, which can greatly help you diversify your portfolio and spread your risk. With low expense ratios and fewer brokerage commissions than mutual funds, they are a cost-effective way of investing. Want to get started by investing in your favorite ETF? With CC Trader, you can trade thousands of ETFs and other instruments including stocks, bonds, and funds in over 40 international markets. Start by downloading the app from the App Store or Play Store or visit the website. Create an account and deposit some funds. Use the powerful search to find your favorite ETF and hit buy. The ETF has been added to your portfolio. If you found this video useful, please like and subscribe to our channel for more content like this, and don't forget to click on the notification bell to get updates.